Good evening, everyone. It gives me immense pleasure to welcome you all to today's professional seminar on internal audit, rewriting for the future a project finance perspective. On behalf of the Internal Audit Standard Board I, C. Ajinkya Randive, extend a warm welcome to all the esteemed professionals who have joined us today for this insightful session. We truly appreciate your presence and commitment to continuous learning and knowledge sharing. I would like to begin by welcoming CA Chandrasekhar Chitale sir, Chairman Internal Audit Standards Board ICI,
Good
and
evening.
CA Ravi Kumar Patwa sir in absentia, whose guidance and leadership have been instrumental in shaping the objectives and structure of today's session. It is now my privilege to warmly welcome our distinguished speaker, CA Archana Moges. I request CA Chandrasekhar Chitale sir to kindly guide us for today's program.
Thank you. Ladies and gentlemen, dear members, Internal Audit Standards Board is in a process of enlightening in the arena of internal audit. And this webinar is a weekly feature where various topics which are of relevance to internal audit are considered. And the speakers who are delivering those lectures are really experts. Like today, Archana would be talking about the topic in which he has already worked, and she will share her expertise. So maybe 2 months reading, you can condense it in maybe 90 minutes lecture. So that is the advantage of this series. As far as Internal Audit Standards Board is concerned, we are in the process of two major projects. One project is uh, reviewing and rewriting the internal audit standards. So standards on internal audit are under reconsideration, and maybe by August month end, we should be ready with the final draft, which shall be released for public comments, and then the board will announce those standards as applicable for the purpose of internal audits. When we share these standards for public comments, we would expect that uh, you should point out if there are any refinements that are required, if there are any inclusion, exclusion, so that the standards become wholesome and of more utility. So that is one project. And the second project is number of chartered accountants are doing bank audit as a concurrent auditor, as internal auditor. And RBI also makes it mandatory to have internal audit and concurrent audit depending upon the loan size of the particular branch. So the background material was prepared earlier, which has become now outdated. So the committee is in the final process of revising that background material for concurrent audit of banks. So that also will be released concomitantly, maybe by August end. The drafts are ready. We will be internally circulating them to experts in banking field. If any of you is desirous of reviewing them, maybe you can write a mail to the Internal Audit Standards Board. The email ID is IASB, Internal Audit Standards Board, that is IASB @ICAI.in. And we will share those drafts with you, and you may offer your comments on the background material. So these two projects will further enrich the internal audit scene. And after we make these two publications, maybe the board will also represent before various authorities, corporates, stock exchanges, bankers, that the chartered accountant should be more and more involved in conduct of internal audits, in conduct of this concurrent audits. Today, internal audit is not mandatory for other sectors like maybe cooperative sector, central cooperative organizations, state cooperative societies. So there also we will be representing to the ministries that this internal audit, because in cooperative societies more than corporates there is a public stake involved. So maybe after a particular threshold of turnover or borrowings, internal audit also should be made mandatory. So that will maybe open up more field for the purpose of our practice. So these efforts are on. If one feels that there are certain other segments where the institute can represent and ensure that the internal audit is made mandatory in those fields, we welcome it. Of course, as a bottom line, one has to remember whatever comes with statutory mandate is seen as a statutory burden. But whenever you are doing internal audit and you positively contribute to the efficiency, to the economy, to the well-being of that organization for the purpose of more transparency, ensuring corporate governance, and that way value addition is made. I think corporates embrace wholeheartedly the process of internal audit. So our effort, our objective should be to make more value addition rather than to have shelter of statutory recognition. So with this background, various webinars are being designed. After understanding the topics, the members can also consider how in a particular background or how in a particular discipline he can positively contribute, and his services are sought after not as a statutory burden but as with pleasure, because there is a value addition, some inputs for the purpose of organization. I thank Archana for uh, agreeing to spare her time and really sharing her insight and inputs in the field in which she is expert. And I'm sure if you have any queries, you may post them in the chat box. The Ajinkya, who is moderator, he will read those, and maybe at the end he can ask those queries to the lecturer, who will ably try to address your issues. Thank you.
Thank you, sir, for enlightening us with updates on many initiatives Internal Audit Standard Board is undertaking under your chairmanship. I also welcome CA Aarti Bansal ma'am, Secretary IASB. Further proceeding, I take now pleasure to introduce our speaker, CA Archana Moge ma'am. Ms. Archana Moge heads the internal audit function at NIIF Infrastructure Finance Limited as a director. She is an internal audit, fraud prevention, and investigation professional with over 25 years of experience. She has worked with leading banks and financial institutions, including HDFC Bank, Axis Bank, NPCI, and Bombay Stock Exchange. She is also a recognized leader and contributor in the field of internal audit. Archana ma'am is qualified as a chartered accountant, CISA, CFE, and Diploma IFRS, ACCA UK. She is also an active speaker at various seminar, conclaves, roundtables organized by IIA, ICAI, and WARC. Ma'am, we are honored to have you with us, and we look forward for your expert insights on today's topic. With this, now I hand over the session to our today's speaker to take the program forward. Thank you, ma'am.
Thank you, Ajinkya ji, and thank you, Mr. Chitare, for your kind words. I'm honored to be speaking from this esteemed platform of Institute of Chartered Accountants of India on a topic which is very close to my heart. One is internal audit, and the second is project finance. I'm really happy that I have got this opportunity to speak on something which is so relevant, and something which is really so important for the economy of our country as well. I mean, project finance is something, you know, which is very critical for infrastructure. Infrastructure development is on the boom, especially in India. So I'm really happy that Institute has selected this topic, for more and more opportunities for chartered accountants in this sector. So with your kind permission, I can start the session.
Yes, please.
Yes, ma'am.
Yeah.
People are eagerly awaiting the discussion.
Yeah. Okay. So, yeah. So just is the PPT visible?
No,
Okay,
ma'am.
I'll have to share this one second. One second. Okay. Yeah. Is it visible now? Yeah.
Yes, ma'am.
Yeah. Okay. So the topic that I've selected is internal audit rewiring for the future. Okay. So it's a project finance perspective. So here, what I want to really, equip our chartered accountants with is the project finance perspective for internal audit, because I think internal audit is something which everyone knows. Okay, we have the standards. The special focus over here is on the project finance. Okay, so while doing audit, what happens is we usually come across, and people, might come and say, the stakeholders might say that, okay, do you understand project finance? Okay, is a chartered accountant equipped to understand project finance? So the main focus of this presentation is to equip our members with the essentials of project finance and the basics of project finance. Okay. So with this in mind, I have designed this presentation. And also another thing is also I want to rewire for the future. So like we have the RBI guidelines which has come recently on 19th of June. Okay, those guidelines are applicable prospectively with effect from October 1st October. Okay, so when chartered accountants go from 1st October to go and audit, so at that point of time, like with respect to provisioning or other requirements, so they should know as to what are the applications and what is the applicability of this provisioning, from when it is applicable. Okay, so to know the nitty-gritties. So just I'm starting with a disclaimer. So this presentation is intended only for educational purposes and does not replace independent professional judgment, and statements of facts and opinions are in my personal capacity and not in my capacity of my employer. Just a moment, 1 second. Yeah. So I'm sharing the agenda which I have set out. The first is, if you see the capex as such, the capex planned for infrastructure sector, it was about 13.7 lakh crore in 23-24, and now the same capex has increased to 15.5 lakh crore. Okay, so it is all the more important for the development of our country and the GDP of our country that we focus on infrastructure, and so that nothing goes wrong. So it's a very critical and important task for chartered accountants to ensure that the audit covers everything in project finance. So the first is understanding infrastructure and project finance. What exactly is the definition of infrastructure? Then the characteristics and the challenges, the debt funds role, the regulatory environment, which is RBI project finance directions, the monitoring mechanisms available, which respect to covenant monitoring, and here like CA certificate, etc. is involved. But from the internal audit perspective, the covenant CA certificate is to be checked by internal audit, and internal audit doesn't have any role with respect to giving the certification. Similarly, with respect to end use certificate, the utilization of the funds, internal audit doesn't have a role with respect to giving the certification, but as a part of check, we need to ensure that the certificate is in place by a chartered accountant. Then we have other specialized items like trust and retention account. So from the monitoring mechanism, the trust and retention account also becomes absolutely important, because the funds and the revenues generated in these accounts, these are kind of escrow accounts, and even the expenses are incurred from these sub accounts. So it is important to understand what exactly this TRA are, and how they can be monitored, in the sense what should be the revenue, what should be the expenses, how the waterfall mechanism happens, which expenses are allowed, which expenses are not allowed. Again, all these things are guided by the agreement, the loan agreement. Okay, you can call it as a common loan agreement, depends. Okay, then we have mobile testing labs to check, check whether the uh, power which is generated and the equipment which is used, okay, is in proper condition or not, for, let's say, for the power sector. So this is power sector is just one of the sectors in the entire gamut of infrastructure finance. Okay. So, and last but not the least, the hot topic which everyone wants to speak about, which is the use of AI. Okay. So how AI can be used. Well, this is not an AI related presentation, but just a use case of AI, which obviously internal auditors can always harp on.
Yeah, in each case, people ask what is AI rule. So that's good you are explaining.
Yeah, yeah. Yeah. So first, I'm just going to what exactly is infrastructure. So the Department of Economic Affairs has defined infrastructure, and whatever is included in this list is classified as infrastructure. Okay, so this is called as the harmonized master list, and the department frequently it reviews this definition. Okay, just notable thing is electric vehicles is not included in this, so that is not considered as infrastructure as such, or maybe the battery operations or the charging stations, that is not included as of now in the definition of infrastructure. Okay, so these are the five sectors which are considered as infrastructure: transport, then energy, water and sanitation, communication, and social and commercial infrastructure. Okay. So to start with, so what does transport include? So transport again includes road transport, so building of roads, highways, okay, toll plazas, bridges. Then it also includes airports. Okay, so there are many airports, small and big, coming up throughout the country. So this is a very booming sector. So airports are covered. In fact, even seaports are covered. Okay, inland waterways, railway tracks, railway rolling stock, railway terminal, okay, logistics, bulk material transportation. So entire gamut of transport is included in it. So this all this definition is right from the Department of Economic Affairs. It's called as the harmonized master list. Okay. Then the next sector is energy. So with respect to energy, again, there are three main things, I would say. One is the electricity generation. Second is the transmission of electricity. Okay. Transmission can be from the generator to the buyer. Okay. So here it is not only the retail consumers, but also there are industrial consumers. So all that is included in transmission. Okay. Also, we have various mechanisms or various methods in which electricity can be bought and sold. So there are open access, there are group captive or captive users. Okay, so it depends. The terms and conditions of the agreement, it depends on what model it is. Okay, or it can be a independent power producer, or it can be a merchant model. Okay, that is whatever is the current rate, you buy and sell at that rate. Okay, the third leg is the electricity distribution. So distribution part, it's mostly from the discoms to the end consumer, maybe the retail consumers. Okay, uh, so now within energy itself, there are like two parts. One is the conventional energy, and the other is the renewable energy. So renewable energy, the focus is more on renewable energy nowadays, and countries like China are definitely ahead of us, but we are also not far behind. And we also have our net zero targets, and till 2030 our target is 500 gigawatts through renewable energy. And then there is something called as energy storage system. So this is also something which is very, very important, because it's not only generation, transmission, and distribution, but how you're storing the electricity. Like for example, for if there is some solar project, so solar project, the electricity generation is mostly during the day. Okay, but at night time there is no generation. Okay, so what happens? Like, okay, so what happens during the night? Because when there might be a peak demand during the night time, your air conditioners are getting used, fans are getting used. So how does one satisfy? So the solution for that is the energy storage systems. So that is equally important. Okay. Similarly for wind energy, so wind energy, most of the generation happens during the monsoon season, when there is a lot of wind. Okay. But maybe during the winter season, there is not much of wind. Okay, so it all depends on what kind of renewable energy is used. Okay. Then the other sector is water and sanitation. So in that we have solid waste management, water treatment plants, sewage collection, treatment and disposal system. Again, all these things are very important for our cities of India. Irrigation, storm water drainage system. Then telecommunication, data centers. Okay, these are also equally important items, because communication is actually the backbone of our country. And we have the social and commercial infrastructure. Okay. So social and commercial infrastructure includes a variety of things. It includes educational institutions, sports facilities, hostels, tourism infrastructure, industrial parks. It also includes storage. It also includes cold storage, warehousing, okay, soil testing laboratories, and so on. Even affordable housing is also included as a part of this sector. So what exactly is infrastructure? We have just seen in this definition. So let us go and understand what exactly is project finance. Okay. So project finance is a method of raising long-term debt finance for major projects through financial engineering based on lending against the cash flow generated by the project alone. So the very important thing over here is the security for the project is mostly the cash flows generated by the project, whether it is a toll road. It all depends on what is the uh, estimate of the toll which is going to get generated, which would be funding the initial expenses which have been incurred for building the road. Okay. Same thing for the power sector. The initial construction cost would include setting up the solar panels or setting up the wind turbines, and what is the tariff for the electricity generated, which is going to come, and which would be the major security. So for this itself, the TRA account is important, because from here the project will be funded, and here the cash flows would be coming. Again, it depends on the detailed evaluation of the project's construction, operating and risk, and allocation between investors, lenders, and parties to the contractual and other arrangements. So now project finance, it involves one or more corporate sponsors uh, investing in a SPV, okay, and through a legally independent project entity financed with limited or non-recourse debt, okay, because there is no other security as such. Yeah. So this is example of a simplified project structure. Okay. Uh, so essentially, there has to be a shareholder agreement, because whenever there is a debt funding, okay, first of all there would be equity, and based on that there would be a leverage percentage. So mostly it is 20 to 30% of equity, depending on the internal policies of the organization. And then there is non-recourse debt. Either a bank would be sponsoring, or there would be other multilateral agencies, or there would be some NBFCs or other financial institutions or AIFs. Okay. So here we have the equity shareholder agreement. Okay. So here there is a sponsor A, B, and C, and then they are investing in a project company, which is a power plant. Okay. So there is a skin in the game, kind of, there has to be equity percentage, and stakeholder has to be there. It can't be 100% debt, it can't be 90%. There has to be a equal balance between risks and rewards. Okay. Then there are factors involved like the labor, the gas and other inputs, and technology licenses. So there is, plus there are things like equipment contracts, construction contracts, and operating agreements. Okay. So these are all the inputs on the left hand side. If you can see my mouse pointer, and on the right hand side you have the output. Okay. So now our revenues would depend obviously on the output, that is the tariff and everything, and basically it's a function of the tariff and the number of units generated. Okay. So here there would be a purchase contract. So it is important that these contracts are well in place, those contracts are signed. Okay. The tariffs are defined, the termination clauses are vetted properly. Okay. Like these are kind of the risks for the even the lender. So this needs to be checked properly. Then the inputs are also equally important, that is the supply of the input. Similarly, machinery and the contract, the OEM for the machinery, then the insurances, the warranties for the machinery, these are also equally important. So let us look at who are the parties involved, their interests and the roles. Okay. So here, first thing we have is the project company, the borrower. Then we have the sponsor and the shareholder, the banks and the financial institutions, the construction company who is going to construct the project, the operator, and the government. Okay. So here, typically, if it is a PPP, that is a public-private partnership, okay, even the government would be involved, and also government's role will be there in awarding the contracts. For example, a toll road contract, the government would be, or NHAI would be giving those contracts, okay, or power sector, the government approvals will be required. So it's in detail we can see in this slide. So government is a key project participant, and government provides the concessions. Okay. It's generally called as a concession agreement in case of road. Okay. And the rights to the SPV to build and operate the project via power legislative and regulatory framework that allows SPVs to compete on a level playing field with other government owned entities. Okay. Then you have the sponsor, like we saw in the earlier slide. So the sponsor or the promoter, he is the one who initiates the project and he sets up the SPV or the special purpose vehicle, okay, recruiting talent and ensuring that the equity it is funded with proper equity and risk appetite. Then the SPV is responsible for delivering a bankable project in financing phase. So here, it's important that the ownership is separated from the sponsor. Okay. After the commissioning, it operates the project through OEM contract if necessary. Then the other part is the project lenders. Okay. So the project lenders are typically a consortium of project lenders led by lead bank, and it can be a consortium or it can be a single lender. The security, main security is the cash flows. Mortgage is also there, but that is not the primary security. Okay. It can also involve pledge over equity shares, and there is a separation between the project uh, SPV and the sponsor. Okay. Um, Normally they do not interfere with the functioning of the SPV. That is, the sponsors will not interfere with the function, okay, nor the lenders will interfere because it's a separate vehicle. Okay. And you have the EPC contractor who designs and erects and provides the project on a turnkey basis. Obviously, this is important for the under construction phase. Post commercial operations, the role of EPC contractor is limited with respect to the maintenance and the operations. Then you have the O&M contractor who's responsible for the maintenance of the project in accordance with the best practices. So before we go into detail, let us understand what are the challenges faced by the infrastructure sector. Okay. So bank loan, typically the repayment of bank loan is compressed for a shorter period because with respect to the banks, the main source of funds for banks is deposits. Okay. So deposits are generally 1 to 5 years, or even from a few months to a few years, but mostly it's lesser than 5 years. So for the ALM, it is important that you have someone who can buy the bank loans, okay, and spread the infrastructure loan over a longer period of time, because banks do not have that risk appetite for longer term bank loans in terms of matching the ALM. Okay. Secondly, if you squeeze it to a shorter period, the installments are very high. If the installments are very high in the initial period, then the project becomes not feasible. Okay. So the viability of the project gets strained if if you squeeze the repayment period for a shorter period of time. Fourthly, the ability of promoters to generate fresh equity out of internal generation gets restricted if it is for a shorter generation of time, because the projects are huge and is generally for a very high gestation period. Okay. And if high user charges are levied on the project just to ensure that the repayment is done in the initial or a shorter period of time, then the number of buyers will be less, and it will be unfair, it will be discriminatory also. So now let us look at the features of the infrastructure loans. So long gestation periods, long-term viability. So that is the feature of the infrastructure loan. large capital investments and ticket size, longer amortization periods, repayment tenor to bear correspondence to the cash flow. So it is scheduled, or it is designed, the repayment tenor is designed in such a way that it matches with the cash flow generation, okay, of the particular SPV. Okay. Uh, sorry. So also there is a requirement to smoothen the cash flows in order to ensure the long-term viability of the project. The other part is it is undertaken via SPVs. Now, SPV is a distinct entity, economically and legally independent project company. Uh, you can see over here the SPV is involved, and there are multiple stakeholders over here. The project assets, liabilities, cash flows, and contracts are separated from that of the sponsor, conditional on what accounting rules permit. And the investors and creditors have a clear claim on the project assets and cash flows, independent from the sponsors. And the debt is non-recourse debt. So to minimize the risk of the failure, the SPV sets up a network of contracts. So it is very important to vet the PPAs, power purchase agreement. Okay. In case of transport, it is important to have the concession agreements checked. Okay. What do the concession agreements say? Okay. From audit perspective, understanding that all these things are existing and checking whether they are available. Okay. In case of a consortium, it is important to check the intercreditor agreement. Now let us look into the major characteristics. So the SPV is a highly leveraged project company with concentrated equity ownership. Okay. Then partly due to the firm's need for flexibility and excess debt capacity, syndicate banks or financial institutions can provide the debt. Typically the debt equity ratio, it can range from 70% to 80%, and there can be more than one sponsor also. The governing board can comprise of the affiliated directors from the sponsor company. So here again, it is important to have the KYC, and all those aspects are important from the audit perspective, because the beneficial ownership data, beneficial ownership declaration with respect to the RBI guidelines, all these aspects become important from audit perspective. So let us take a look at the value creation by project finance. So that is the reason that infrastructure projects are included in project finance, that it is not like a plain vanilla retail loan. Okay, it's different, and that is why specialized knowledge is required, and specialized or customized loan agreements are required. It's not that one shoe fits all kind of a bill. Okay. There's concentrated equity ownership, or separate ownership, and a single cash flow streams, okay, from which it is to be monitored. So on the right hand side, if you can see, there is a diagram. So this diagram is showing the water flow mechanism, okay, as to how the funds will come and how the funds will go in the construction period as well as the operations period. Okay, so first, we will go through the left hand side, which is the strong debt covenants allow both sponsors and creditors to monitor the management. So debt covenants are very, very important, and monitoring of those debt covenants. So as an internal auditor, you need to check whether the covenants are being met, whether the covenant certificate has been provided by the borrower, whether it is in order, and if it is not in order, whether this particular aspect, borrower, is included in the monitoring, or is it, does it trigger any alert with respect to red flag with respect to not meeting the covenants. Then there is extensive contracting, which reduces the managerial discretion in the SPV. And you can see the cash flow waterfall mechanism, okay, as to how the funds are allocated. Okay. Similarly, NBFC loans, in case of NBFC audit or internal audit assignments, you can check that NBFC loans can be used instead of bond, or even bonds also can be used, but it facilitates speedy resolution and structuring due to bilateral agreement. So the sponsor equity, bank loans, and mezzanine debt or multilateral institutions give the project finance during the construction period. The interest as such would be capitalized because there is no revenue generated during the construction period. The outflows happen for statutory expenses, EPC contractor payments, pre-operative expenses, interest during construction, of course, but interest during construction is mostly capitalized. The margin money and the contingencies. Okay, once the project is completed its commencement, okay, or the commencement certificate is issued, then the revenue can be generated from the project revenue, insurance claim, and liquidated damages. With respect to operations period, the expenses can be again statutory expenses, O&M expenses, interest payments, principal payments, repayment, okay, MMR and DSRA, DSRA account, dividends, promoter loan payments, and surplus. So whatever is the surplus, it goes to the promoter or several. With respect to the debt service account, uh, it's important to understand what exactly is the debt service reserve account. So this is a form of a security. So this is called as debt service reserve account. So it may be kept in the form of a fixed deposit or in the form of a bank guarantee. Okay, so this DSRA is a cash reserve which works as a security measure for the lender, as it ensures that the borrower will always have funds deposited. So this DSRA is mentioned and is stipulated as a condition in the loan agreement, and there's a calculation which goes into show, like this DSRA is typically an amount calculated based on the repayment schedule, and the peak amount for the repayment and the interest is taken as the DSRA. So now the purpose of the DSRA is to provide a cash buffer, where cash available for the cash flow for debt servicing is less than the scheduled payments. So the DSRA balance can be utilized in such cases. Okay. And the DSRA, the FD or the bank guarantee can be revoked, and it can be executed. FD can be liquidated. The funds within the account are not expected to be used in the base case financial model. So now here, it is important. One second. Here it is important that DSRA is used to fund the shortfalls. However, the funds with the accounts are not expected to be used in the base case financial model. Operations and fundings of DSRA, debt service reserve account. Okay, so the debt service reserve account is funded up to a dynamic target balance. Okay, so this target balance is calculated based on the repayment schedule. Okay, so I have taken in an example and we'll just look at it. So the target balance includes both interest and principal repayment, and the requirements will be defined in the term sheet and include fees. Okay, the target is typically 6 to 12 months or maybe a fixed amount. It can be 1 quarter or 2 quarter or 3 quarters, depending on how the project has been designed and how the repayment is conceived or how risky a particular project is. So this is an example of the calculation of the DSRA, which the internal auditor should check whether whatever has been mentioned in the debt service reserve account in the agreement is available or not. So also the calculations need to be checked whether the correct amount is available or not. So if you can see over here, this is the repayment dates over here. Okay, this is the date, percentage of loan which is to be repaid, which is appearing over here in the repayment column, and in the balance outstanding, the interest amount is calculated. Now this DSRA required is the total of this interest amount and the quarterly repayment. So this is February, May, August, and so on. And this DSRA required is a total of interest and quarterly repayment. So if you see over here, like 1, 2, 3, 4, 5. So peak DSRA, the peak amount over here, okay, which is 707,101,356 is considered as a peak DSRA. So they are required to maintain a DSRA in the form of a FD or a bank guarantee for this particular period of this much. Okay. For the next period, that is 31st March, they are required to maintain the peak amount based on the next repayment. Okay. So this would ensure that in case of any issue, in case of repayment not happening, the DSRA amount can be liquidated, and at least for, from, if you see Feb 2022 to 2023, okay, which is a period of 1 year, the DSRA can be liquidated and used till till the project issues are resolved. Yeah. So now let us take a look at the major project contracts. The first is the off-taker contract. So off-taker is nothing but the person who is buying, say in case of a power, he's buying the electricity, the power. In case of road, we don't have off-taker, we have a concession agreement. Okay. So now off-taker, this agreement provides the off-taker with a secure supply of project output. So as it is, the security in this case is the project revenue. So how does the revenue get secured? By entering into contract with the off-taker who is going to buy whatever power has been generated in case of a power project by the generator. Okay. And the project company with the ability to sell the output on a pre-agreed basis. Okay. Now this can take various forms such as take or pay in case of merchants, or it can be it is generally called as a PPA or a power purchase agreement. Okay. The input supply contract is equally important to ensure that the functioning of the project is and the operations of the project is happening properly. It provides the project company the security of the input supplies on a pre-agreed pricing basis so that there are no spikes in the input cost, because again, in order that the revenue is coming and the loan is repaid, it is important that the cost control is also there. The terms of the input supply contract are usually crafted to match that of the off-taker contract, such as input volume, length of the contract, force majeure, etc. Now, these are the other important aspects, okay, which is the construction contract. So that is applicable in case of under construction projects. The contract defines the turnkey responsibility to deliver a complete project ready for operation. And the O&M contract as to who is the O&M party. It is important that to have good reputed persons who will be conducting the O&M, and also the costs need to be taken into consideration. So there is a base case model, okay, the project finance, which is required to be checked during internal audit. So whether whether whatever is budgeted is happening or not, okay, or whatever assumptions are included in the financial model, whether they are correct, or is there something irrationally included in the assumptions which is not contracted. Then there are permits and licenses, which is more of a part of the government support agreements or local authorities. And this slide is just a primer to explain the role of infrastructure debt funds. Okay, so these requirements on the left hand side are typically what an infrastructure debt fund can do, or an NBFC in IDF can do. Obviously, they can do only operational project. Okay, they cannot do under construction project, which invest in PPP, and they should have completed at least 1 year of satisfactory commercial operation. So in that extent, the risk of such projects is low because already construction has been completed. And there's a tripartite agreement between the lender, borrower, and the government authority. And so this is a non-deposit taking NBFC is an IDF, and it is permitted to invest in COD +1 and toll operate transfer projects also. Okay. And the NBFC is a middle layer NBFC. So in the base layer, middle layer, and the upper layer, it is classified as a middle layer, and the profits are exempt from tax. So as an internal audit, these conditions need to be checked, whether those conditions are met in order to enable the profits being exempt from tax. Yeah, so this was a primer on what infrastructure is and what an infrastructure debt fund is. Okay. Next, we come to project finance directions. Okay, so RBI has come out with the project finance directions in June 2025, and earlier they had issued draft guidelines and taken feedback from infrastructure finance companies. However, there was a lot of feedback coming from banks and financial institutions that the provisioning requirements were very high in terms of asking 5% and so on. Okay, provisioning. So now let us take a look. So why exactly are these guidelines required? Okay. So the prudential framework for resolution of stressed assets was issued in June 2019, provides a comprehensive framework, but restructuring of exposure related to projects under implementation due to change in DCCO. What is DCCO? It is the date of completion of the project. Okay. By the date of completion, I mean the date of completion of construction of the project. This was excluded from the ambit of the prudential framework. Okay. So hence, these guidelines are in place to harmonize for all the regulated entities under the project finance. So as I said, the circular was issued on 19th of June, and it is effective prospectively from 1st October. So, we have time, and the finance companies and banks also have time, because they still have 3 to 4 months for this to go live. Okay. The objective is to strengthen the risk guardrails in project finance and harmonize regulations across all the regulated entities. So when you say all the regulated, it applies to banks, NBFCs, urban cooperative banks, all India financial institutions, and HFCs. So all of them will be guided by this regulation. So this is the circular for project finance, which includes infrastructure and non-infrastructure sector. So with respect to non-infrastructure sector, it includes commercial real estate and CRE-RH. CRE meaning commercial real estate pertaining to residential housing is also included. Okay. Now the major purpose of this circular is for change of DCCO. So these are all infrastructure projects, and they have huge gestation period, and a lot of capital is required. It's very, very capital intensive. So the restructuring of exposure related to projects which was excluded in the ambit is now included in this framework. And harmonization of all the guidelines, and also these are the powers exercised under these sections. So under the Banking Regulation Act, section 21 and 35, then chapter 3b of RBI Act 1934, okay, the National Housing Banks Act 1987, okay, and these are the three things wherein it is not applicable. These guidelines are not applicable. It is not applicable for projects where financial closure has been achieved on the effective date. That is, we will take a look at what is the definition of financial closure. It essentially means that the equity has been arranged and at least 90% of the debt has been arranged. So that is financial closure has been achieved. So those projects where financial closure is achieved before October, okay, these guidelines are not applicable. But if there is a credit event, or if there is a change in any of the uh, if there's a change in any of the requirements or any of the agreements, then it will continue to be guided by the uh, prudential guidelines. Okay. If there is a change in any of the guidelines, then it will come under the ambit of this circular. Okay. Next is resolution of a fresh credit event or change in material conditions, then of the contract. Then again, these guidelines would be applicable. Yeah. So, what are the key themes of these final guidelines vis-a-vis the draft guidelines? The key theme was that there is a lower provisioning requirement vis-a-vis the draft norms. The draft norms required 5%. Now, with this, under construction project, provisioning requirement is reduced to 1%. Okay. And operational projects, provisioning requirement is 0.4%. Okay. Prospective applicability, which is applicable from 1st of October. So that eases the credit cost burden, because lots of projects have not taken into consideration such high provisioning requirement which the draft circular provided. So it would be unfair, and the projects would become unviable, because obviously if the provisioning requirement are so high, the cost of credit also increases. The improved ease of doing business for the lenders, and other important point is the 6-month moratorium limit after the DCCO has been removed. Okay. And this, because of this funding outlook has because of this circular, the funding outlook has improved for 125 to 135 lakh crore capex. So now let us take a look at the key concepts in this circular. Okay. The first is the appointed date. So this is a very beautifully prepared circular, and it gives in detail on various definitions like appointed date, credit event, okay, what are the various phases, and this circular is very important if someone wants to understand project finance also. Okay. So the date defined in the concession agreement between the concessionaire and the concession granting authority, on which the agreement comes into force of infrastructure under PPP model, that is called as the appointed date. Okay. Now, what exactly is PPP? So for PPP also, there are a few conditions which need to be satisfied. Okay. Now these conditions, so now it is important to understand this PPP concept, because even the risk weights for the banks depend on whether a project is PPP or non-PPP. Okay. So if a project is PPP, then for NBFCs, generally the risk weights are 50%. Okay. If it is a non-PPP, the risk weight is 100%. Okay. Similarly, for banks, uh, the risk weight depend on the credit rating of the bank. Okay. But for NBFCs, it's more on PPP. Okay. Now, PPP is an arrangement between the government statutory entity, government-owned entity on one side, and the private sector on the other side. Okay, so this is one, it has to be a partnership. Second is, it has to be for provision of public assets or public services. It is not for any other retail consumer based item. It is a public asset and public services through investments, because huge investments are required. That is why government is participating in this. Okay. It is for a specified period of time. Okay. So that time has to be specified in that PPP arrangement, and there is a defined allocation of risk. So both the public as well as the private sector, public entity as well as private sector, they participate in the risk taking. Okay. Now, who is chosen on the basis of competitive bidding? So the allocation or the allotment of the contract should be on the basis of open and competitive bidding. Okay. Then, based on the allocation of the contract, there would be performance linked payments that conform to benchmarked or specified and predetermined performance standards measurable by the public entity or its representative. Okay. Now, the date of commencement of commercial operations, DCCO, as I said. Okay. So there are three concepts: original DCCO, extended DCCO, and actual DCCO. So now this date of commencement of operations is very, very important, because that is the defining movement which will determine, whether the project risk with respect to construction is over or not. Okay. Once DCCO is achieved, the construction risk is over, and it is the operations which has to be considered. Okay. So original DCCO is the date as envisaged at the time of financial closure. Now, financial closure is what exactly? When the contract with respect to financing of the project is signed. Okay. So that is the date mentioned in the contract between the borrower and the lender. Okay. Which is envisaged in that contract. Okay. So when the particular borrower envisages, he has to put in design the project and provide a estimated timeline. Okay. So it is a timeline for putting into commercial use, and completion certificate, provisional completion certificate is expected to be issued to the concessionaire. Next is extended DCCO. If the original DCCO is revised, then the revised DCCO is termed as extended DCCO. Next is the actual DCCO, the date on which the project is put to use, and the CC or the OC in case of CRE, that is commercial real estate or real estate residential housing project is issued. So for CRE projects, it is the CC and the OC. For other projects, it is the COD, date of commercial operations. Date of financial closure. Okay, as mentioned in the first line, the time of financial closure is the date on which the capital structure, including the debt, equity, or grant for a minimum 90% of the project cost, becomes legally binding on all the stakeholders. Then the next concept is for a credit event. So the credit event is deemed to have been triggered on the occurrence of any of the following. One is default with any lender. So if there's a consortium, any lender you're defaulting, then all the lenders, it will declare that as a credit event. Okay. Now, default is non-payment of the debt as defined in the insolvency and the bankruptcy code. So credit event happens when there's a default with any lender, or any lender determines a need for extension of the original or extended DCCO of the project. So if the DCCO has not been achieved as intended, as per the planned DCCO, original DCCO, and lender determines, then you can call that as a credit event. Okay. Or when the expiry of the original or extended DCCO has happened, even that is a credit. Expiry has happened and DCCO is not achieved. Or any lender determines that maybe you will need additional debt. That is also a credit event. The project is faced with financial difficulty as determined under the prudential framework, even that is considered as a credit event. Yeah. So upon the occurrence of any such event, lenders are required to review the account within 30 days of the occurrence of the event and implement a resolution plan. Okay. I mean, I've included this also in the credit event because it is important that we realize what exactly is the importance of credit event, because that is the time by which the resolution plan should be implemented. So with respect to audit, if there is any such credit event happening, or the DCCO with respect to under construction projects, then one needs to check if this account has been reviewed within 30 days and a resolution plan has been entered into. Because in the original agreements, the DCCO would be there. So as part of internal audit, you can always check what was the DCCO and what is the stage of completion of the project. Yeah. So the method of funding the project, in which the revenues to be generated by the funded project serve as the primary security. So what exactly is project finance? The method of funding a project in which the revenues to be generated by the funded project serve as the primary security for the loan and also a source of repayment. Okay. It can be either a greenfield or a brownfield project. Which is, greenfield is a new project or a brownfield is an existing project. The exposure shall quantify as a project finance exposure only if the following conditions are satisfied. One is predominant source of repayment envisaged must be from the cash flows. Okay. So it is not like there is a huge mortgage and that is the preliminary source, preliminary security. The primary security is the revenues. Okay. And then second is all lenders have a common agreement with the debtor. Okay. There's a common loan agreement. The common loan agreement can have different terms for each borrower. However, the other lenders should have agreed on those terms and conditions agreed by the debtor and all the lenders to the project. So what exactly is the resolution plan? So in the earlier slide, we saw that within 180 days of the credit event, the resolution plan has to be formed. So resolution plan is a mutually agreed and legally binding time-bound plan for resolution of stress in a project finance account. The resolution plan may involve any action, plan, reorganization, which is including but not limited to regularization of the account by payment of all the overdue, sale of exposures, there can be a sell-off also, there can be a change in ownership, extension of DCCO and restructuring. Even the DCCO can be extended. So we'll see that later how and when and how much time the DCCO can be extended. Okay. Then there is also concept of SBCF or standby credit facility that is sometimes decided at the beginning of the project itself. So that is a contingent credit line sanction for the project at the time of financial closure. So financial closure initially and the loan is sanctioned to fund any cost overrun during the construction phase. So these are all huge projects. So overrun is quite possible. So at that point of time itself, they have obtained the standby credit facility. Now, this is in short the phases of the project. So phases involve the design phase, construction phase, and the operation phase. The design phase starts with the genesis of the project and includes designing, planning, obtaining all the applicable clearances and approvals till its financial closure. And second is the construction phase. It begins after the financial closure and ends on one day before the actual DCCO. That is the construction phase. And once the DCCO has been received, then the operational phase starts. And with that also starts the repayment of the project finance exposure. The prudential conditions related to sanctions. So approvals, and so these are few of the conditions. So whenever the audit is checking the sanctions, so all these aspects need to be checked whether those aspects are in place or not. Okay. So what are those aspects? all the legal regulatory clearances. Lender has to ensure that all the applicable approvals and clearances are obtained before the financial closure. Second is approvals which are contingent upon achievement of certain milestones. They shall be deemed to be applicable only when such milestones are achieved. So if the milestone is not due, okay, then the particular approval may not be in place. So it will be a contingent approval. So that approval will be there only after the milestone is achieved. Okay. So example, approval to operate a boiler is applicable only after the construction of the boiler. Okay. That approval cannot be in place at the time of financial closure. Then all the projects financed by the lender, they should ensure that financial closure has been achieved and originally DCCO is clearly spelled out and documented. Specific disbursement schedule vis-a-vis completion, stage of completion is included in the agreement. So this is important for the under construction loans because obviously the entire loan cannot be disbursed all at once. It depends on the stage of completion decided and documented in the loan agreement. Post DCCO repayment schedule has been realistically designed or not, okay, to factor in the initial cash flow. So here one can also take a look at the financial model which has been provided and the assumptions behind the model, and also need to be checked that there is no formula or any other error which has come into it which is going to shake the entire design and the repayment schedule. And the original, one of the other important conditions is that the original and the revised repayment tenure should not exceed 85% of the economic life for a project. So this is good in terms of the airports, power projects. They are huge projects for a long period of time. So this is actually not an issue that it should be at least 85%. It should not exceed, it should be not more than 85% of the economic life of the project. So in case of roads, etc., say where the life is 15 years or something, then it should not, the repayment tenor should not exceed 12.5 years. So this condition is important. Credit policy should also include these provisions. So with respect to audit, the important aspect to check is whether the internal credit policy is aligned with the RBI circular on project finance. Just 1 second. So now other conditions relating to sanction include minimum exposure. So in consortium lending, this circular has specified that minimum at least 10% of the total should be financed by one lender. Okay. If the exposure is up to 1500 crore, then at least 10%. Say 300 crore project, then any one lender, say HDFC Bank, it has to at least provide minimum of 30 crore. Okay, 1500 crore. So minimum of 150 crore has to be given by one lender. Okay. Now, if the project size is more than 1500 crore, then the condition is it can be either 150 crore or 5% of the total. Okay. So this is the minimum criteria for projects greater than 1500 crore. Minimum exposure should not apply post DCCO. So this is only till the construction phase. So once DCCO has been achieved, construction has been completed, then lenders can freely acquire or sell exposures to other lenders. Lenders can acquire and sell exposure under a syndication agreement. So now again, here there is a separate guideline, master direction on transfer of loan exposures. Okay. So that needs to be followed during selling off of the, to achieve the post DCCO if lenders want to acquire or sell exposures. Yeah, the next is prudential conditions relating to disbursement. So now we have seen sanction, the next stage is disbursement. Okay. So with the disbursement stage, this is one of the important conditions that lender has to ensure availability of land rights. Okay. So if there's a mortgage or other collateral security by way of a right of way or mortgage, then in case of infrastructure project, at least 50% of the land rights have to be in place. Okay. So this has to be checked as a part of internal audit. Okay, for non-PPP and non-infrastructure projects, it's at least 75%. So the requirement is more stringent for non-PPP and non-infrastructure, that is the commercial real estate project. Okay, and in case of transmission line, it is open-ended requirement. It is as decided by the lender. Then disbursement to be proportionate to the stage of completion. Obviously, it has to be proportionate. You cannot disburse something even if the stage is not complete. And there is someone called as lender's independent engineer. He shall be certifying the stages of completion of the project. Okay. Now, the provisioning guidelines or the standard asset guidelines, let us take a look at the provisioning guidelines. So, for infrastructure projects, the provisioning guideline is 1%. Okay. And for operational phase, it is 0.40%. For CRE, that is commercial real estate, the requirement is much higher, which is 1.2% to 5% construction and 1% for operational projects. With respect to CRE RH, it is 1% and 0.75% with respect to operational phase. The DCCO deferred standard assets. Okay. Now, additional provisioning is required for 3.75% for infrastructure project loans and 0.5625% for non-infrastructure loans, CRE and CRE RH. Okay. For I think there is a typo over here. That should be 0.375%. Now, existing projects which have achieved closure before the effective date. So, closure doesn't mean that the project is over. It means which have been negotiated and financial agreements have been entered. So, provisioning requirements are guided by the prudential guidelines. Okay, and so these are the provisioning only for the standard assets. For the NPA, you need to refer the prudential norms on IRAC. So this is an exposure, this is an illustration which is available in the circular itself. So let's say your funded outstanding is 1,000 crore and your DCCO, original DCCO is 1st of January. Your extended DCCO is 1st of April 2026. Then what is the provisioning required? So there is an extension of 3 months. So DCCO on standard assets, additional provisioning of 3.75 for infrastructure project loans. So additional provisioning is required for 3.75 crores. Next example, if you have an outstanding of 1,000 crore, original DCCO is 1st January, and you have an extended DCCO is 1st of April. So here there is a delay of about 5 quarters from January 26, 4 quarters here and 1 quarter over here. So it is required to be maintained as 3.75 into 5, okay, for each quarter. So this is a quarterly requirement. Okay. If you see over here, this requirement is on a quarterly basis. So this is just a comparison on what the draft guidelines provided last year and what are the final guidelines. The draft guideline provided a provisioning percentage of 5% to 7.5%, but the final norms is 1% and 1.25% for CRE, and for operational project for infrastructure debt funds it is 0.4%. And again, the draft guideline talked about retrospective implication, which would have been a real dampener for the sector, but now with this prospective implications, it is good for the infrastructure companies and the project finance to plan their way ahead, since it is a prospective and they are aware as to how much the DCCO can be extended, what are the terms, okay, for the classification. All those things are out in the open. Now, permitted DCCO deferment. So original or extended DCCO is extended along with shift in the repayment schedule for equal or shorter duration. So including the start dates. For infrastructure projects, it can be extended up to 3 years, and for non-infrastructure projects, it can be extended up to 2 years. with respect to cost overruns, a lender may finance it as a part of the resolution plan. Cost overrun associated with DCCO deferment. So there's a date of commercial operation has been deferred, and also there is a cost overrun. Okay, but the account can be classified as standard irrespective of the cost overrun, subject to these conditions. Okay, that the cost overrun is up to a maximum of 10% of the original cost of the project, in addition to the interest during construction. Then second is the cost overrun is financed through SBCF at the time of the financial closure. Okay. And third is in cases where the SBCF was not sanctioned at the time of financial closure, or sanctioned but not renewed, then such funding shall be priced at a premium to the pre-sanctioned SBCF. Okay. Also, the cost overrun can also be one of the reasons, and also there can be a cost overrun because of change in scope. So costs can increase because of change in scope. So even the change in scope happens, even that can be required higher project outlay because of scope and size. Okay. So now the conditions for this is change in scope, rise in project cost, excluding cost overrun is 25% or more, still the project will be considered as standard, because this is the scope has changed. That is why the cost has increased. Secondly, the lender reassesses the viability of the project before approving the enhancement of scope and fixing a fresh DCCO. And thirdly, the re-rating. That is, the new external credit rating is not below the previous external credit rating by more than one notch. So this is also an important condition, that the external credit rating should not be below the previous external credit rating. So irrespective of the change in scope, if the credit rating declines by more than one notch, okay, then DCCO extension, you may not be eligible for classifying it as a standard asset. Okay. So certain times what happens is that the SPVs knew the debt may be unrated at the time of increase or scope in scope or size, then it should be externally rated investment grade upon such increase in scope or size where the aggregate exposure is more than 100 crores. And the other important part is the standard asset classification benefit on account of change in scope shall be allowed only once during the lifetime of the project. So this is an example which is I picked up from the circular itself. So it's a very beautifully prepared circular, and all these examples are available in the circular. So say the original cost of the project is 1,000 crores and the revised cost is 1,200 crores. So there's an increase of 20%. But the increase in cost of 20% is due to two factors. One is change in scope is 18% and cost overrun is 2%. So will this classify as a standard still, even though it is only 20%? Well, the answer is the change in scope. If it is more than 25% attributable to the cost, then only it is because it can be considered as a standard. So here, in this case, it is less than 25%. So asset classification benefit is not available. Again, similar example. Original cost is 1,000 crore, revised cost is 1,400 crore, and the increase in cost is 400 crore, which is 40%. Okay. So attribution of increase in cost because of change in scope is 30% and cost overrun is 10%. Okay. So now in this case, it is more than 25%. So it will be eligible for classification as standard. In the similar case, if the cost overrun was, let's say 20% and change in scope was 20%, then it would not have been eligible to take the benefit of classification as standard. So this is the circular in short. Before I take the questions, I just wanted to show one more thing with respect to the AI part of it. So when I asked Chat GPT, okay, how will you audit project finance? Okay, I got a few answers which I would like to show you. Okay. Is my screen visible?
Yes, ma'am.
Yeah. Okay. So how to audit project finance, and Chat GPT has given a step-by-step guide. Okay. And identify the SPV, understand the project life cycle. So it is very crucial to understand the project finance before you go and audit project finance. Okay. And what are the critical agreements? Okay. Critical contracts, which is concession agreement in case of roads, power purchase agreement. Okay. Who are the regulatory authorities? Okay. Then how the loan is financed. Okay, that is also important. Then you have the regulatory compliance, Companies Act, income tax, GST. Okay, so basically, I mean, it has become so easy with Chat GPT. It will even give you a checklist. Okay, for the audit. Obviously, human intervention is required, and you cannot go and complete the audit with a checklist. But yes, it does give you guidance. Okay, so it even gives the checkpoints on what are the important ratios and the covenants. Okay, even the timely use, disbursement and use of funds. So basically, end use certificate is something which RBI asks. So in RBI's audit, so it is very important that it's covered as a part of the internal audit as well. Then whether the principal and interest payments are happening on time, how is the interest during construction calculated, and whether it is capitalized properly. Okay. The SMA reports and other reports, you may have to check those for the timely interest and prepayments. Okay. Viewing of the major capex. Okay, so then I mean, it also suggested internal controls and governance. Okay. And obviously report preparation is the last part of the audit. Ultimately it all culminates into the report. So relevant standard guidelines. And then it asks, similarly, ChatGPT suggested a few questions that which project you want to audit. Okay, is it solar or wind? Okay. And I told it that yes, I want to audit renewable energy project. Okay, so again it said, okay, identify what that project is. Okay, now based on renewable energy, it has suggested certain stakeholders. Okay, so because it's a renewable energy, so it is considered it as a power, and it has actually listed out discoms, okay, distribution companies. Okay, it has even listed out Ministry of New and Renewable Energy. It has listed out Solar Energy Corporation, or SECI. Okay, so I mean, beautiful responses. Again, since this is a power, it has harped on what exactly is the power purchase and what exactly you need to check. Okay, so basically the tariff. So basically, for internal audit, one has to check whatever is tariff is mentioned in the PPA, whether that tariff is considered in the financial model or not. Okay, whatever tenor is mentioned in the PPA, whether it is satisfying the requirement of the economic life, whether it is not more than 85% of the economic life of the project. Okay, what are the termination clauses and what rights, because this termination clauses and deemed generation clauses, this would determine on the risks of the project. Because suppose you have a PPA, but there is a termination clause which is not beneficial to the borrower, then that is a risk. So whether that risk has been considered, and if that has been considered, then what is a mitigant for that risk. Again, implementation of the land lease agreements, like 50% of the land for infrastructure projects. And the key covenants for the loan. Okay, the DSCR. Okay, the DSRA, that is the debt service reserve, is available or not. What exactly is the repayment schedule? Okay. Then in case of solar projects, you have open access certificate. Okay, whether it is long term or short term open access certificates. Okay, so this is for solar related. Okay, it has also mentioned Electricity Act 2003, environmental laws. Also, this is, if you see over here, generation data, okay, vis-a-vis projections, that is PLF or CUF. Okay, CUF is capacity utilization, and PLF is plant load factor. So this is basically like what is the capacity and what is the generation vis-a-vis the generation. Also, this SCADA logs and plant output reports are available, so that the monitoring team can use that to check about what exactly is the generation. This is like real-time output from the plant. Okay, it captures like what is the irradiance or how much sunlight is falling on the solar panel. Okay, and basis that, what is the plant load factor, whether it is in line with what was designed in the financial model. Okay. So when the audit is happening, definitely you must ask for the base case financial models. Also, if there is some sensitivity analysis done, then that sensitivity needs to be taken into consideration. Say, if there's a 5% increase in the input cost, okay, so all those sensitivities would be there in the credit appraisal, and that also needs to be checked in the financial model. So then you need to understand what is downtime, what is curtailment. So what exactly is curtailment? So you need to understand this concept. Okay, so curtailment is nothing but, suppose you have generated the electricity, but you don't have the bandwidth for in the transmission line to transmit that electricity. Then you cannot send it to the off taker. You are going to get the tariff from the off taker based on the power that he receives. Okay. But he is not able to receive because the transmission line is already, like, there is a traffic in the transmission line. So you have to curtail your production because you are producing and you are not able to send it. Okay, so you have to curtail your production in that case. So in such cases, the battery energy storage is important. Okay, so even though you have a good PLF, still it is not going to generate the revenue if curtailment is there, okay, or if there's a downtime. So all these are very important things to understand as far as project finance is concerned. Then you need to understand the loan covenants with respect to DSCR, okay, loan life coverage ratio, project IRR, tax incentives, the modules which have been used, the solar model, the what kind of modules have been used for the solar, whether it is, whether it is available on both the sides, solar energy generated by, is it bifacial or is it mono. So that all those understanding is required. These are the additional notes. So I mean, AI can be used to the benefit, and it is a freely available tool. So definitely, all chartered accountants should take advantage of this tool to enhance their knowledge. So again, now this is for the road projects. How to audit project finance for roads in India is what is the question, and this is the answer that they have given. They have given the modes. Okay, so Ministry of Road Transport lists out certain models, that is build, operate, transfer, or hybrid annuity, or EPC. So it talks about all those models. So definitely you can drill more deeper into each of the model and ask what is to be checked, and definitely I'm sure we will get an answer for that. You can see over here build, operate, transfer. Then in case of ham projects, hybrid annuity, what are the things that have to be checked? In the O&M contracts, an MMRA account, that is major in maintenance. So in case of solar, there can be inverter. So whether there's an inverter replacement reserve which is being factored into in the model. And it is also giving sector specific considerations. So it is a very useful tool. I mean, it just how creatively you can think and make the best use of the tool available, and you have the answers at your end. This is for the air transport. This question is for the air transport. With respect to air transport also, it has given the relevant, okay, over here, project finance for airports. It has given the names of the relevant authorities over here: DGCA, ERA, aerodrome licensing. And again, the operational performance related parameters are different than it would be for power or road. So passenger footfall. Okay, for a road transport, it would be the number of vehicles which are passing through the toll plaza. Okay, here it would be the passenger or the cargo. Then the cost factors involved in airport industry. Then the revenues, which is other than non aeronautical, which is generated from duty free shops, real estates, car parking, cargo handling. Yep. With stakeholder compliance for airports with respect to sharing, revenue sharing, and minimum guarantee. So all this is very, very interesting, and the more you ask chat GPT, more your knowledge will get enhanced, and you will get more and more ideas to foolproof your internal audit and ensure that all the major risk areas are covered. This is again, this one is on financing structure for, this is for wind projects. Again, for wind projects, similar to solar energy, similar to power, it's a part of power sector only. Again, it talks about PPAs, talks about debt service reserve account. Yes, so this is what I had to present. Um, I had to offer you. Now, Ajinkya, if you can tell me if there are any questions.
Yeah, ma'am.
Yeah.
Yeah, there are a few questions.
Yeah.
One is, what are all the key updates that is relevant to commercial real estate funding?
Okay. So, so in this particular, my focus was more on infrastructure. Okay. So with respect to commercial real estate, also there are, the major part is, provisioning, the amount of provisioning which is available, which is 1% and 1.25% for commercial real estate and commercial real estate residential housing. So that is the important part. And the other factors are regarding the extension of the rate of completion of the project. Okay. Yeah. So the major part is pertaining to the DCCO, the restructuring, okay, the loan tenor, okay, and how much you can extend on the loan. Like the loan extension also can be done up to a maximum of 2 years only for CRE, commercial real estate projects.
Okay. Next one is, uh, of late, we have been reading that several infrastructure projects, mainly roads, bridges, have been collapsing in almost every state in India. One of the main reason is misuse of funds by the company concerned. To what extent internal auditor of the company is responsible under such circumstances? Are the internal auditors reportable audit findings should include all the phases of the project, say initiation, planning, execution, and closure?
Okay, so here I have a question. This question is on the infrastructure project or on the infrastructure financing of the project. So because here I am covering the infrastructure financing. Okay. I'm not covering with respect the audit with respect to the infrastructure company. Okay.
This query, it seems like it is related to the company.
Correct.
More focus on the company and the role of
Yeah.
the internal auditor while checking the
While checking
company.
the infrastructure company.
Yeah.
So this is limited to infrastructure finance. So with respect to infrastructure finance, it is again, the most important things are the common loan agreement, the feasibility study. Also, the lender has authority to appoint an independent engineer to check as to whatever the estimates are given, they're correct or not, or they are in line with the actual. You know, like for a road project, there may be someone who will do the research on the road traffic. Okay, the traffic is there or not, or is there some alternate route. So it based on that viability and other study, it is important to determine whether you can, land on that particular project. Also for projects more than 100 crore, it is techno economic viability has to be done as per the RBS. So it is important those things are in place. And also I think it is more on assessment by the lender of the promoter of the group, his reputation, his history, which is equally important.
Next is whether internal audit of projects entail responsibility for checking the feasibility of the project. So this is again not related to financing.
Sorry, can you repeat?
Yeah, whether internal audit of projects entail responsibility for checking the feasibility of the project.
No, the feasibility of the project is the credit responsibility. Internal audit's responsibility is not to check the feasibility. However, internal audit can check the financial models and the assumptions made in the financial model, whether they appear to be reasonable or not. Also, it can check whether the financial models are, the calculations and the formula are robust and the Excel sheets are robust or not. And it is summing up the input entered and changing the inputs, the output changes in the same manner. That is the sensitivity, okay, analysis is matching up. Okay. So
The last question, that is, what is accounting as per Ind AS for concession agreement?
okay, the accounting part I have not covered because this is more of the processes. So with respect to that, the relevant India standard need to be referred.
These are the queries that we have received. So we have answered all the queries.
Okay.
Then we'll proceed with the concluding part then, ma'am, if there's nothing else.
Yeah, sure.
So good evening, everyone. As we come to the close of today's seminar on internal audit, the rewriting of future of project finance perspective, I take this opportunity to extend my heartfelt thanks to all of you for making this session a grand success. First and foremost, I would like to express our sincere gratitude to our distinguished speaker, Ms. Archana Moge ma'am, for delivering such a insightful and thoughtful and thought-provoking session. Your perspectives on aligning internal audit frameworks with the evolving dynamics of project finance were really enlightening and will certainly help professionals reframe the approach with greater clarity and confidence. A special thank you for our Chitare sir, ISB chairman, for your continued support and guidance in curating this meaningful dialogue. Your leadership really continues to inspire excellence. To all our professional participants, your active involvement, thoughtful questions, and commitment to staying updated with evolving practices truly reflect the strength and integrity of our professional fraternity. Thank you for being a part of today's event. And last but not the least, take this opportunity to thank the entire organizing and technical team working behind the scenes to ensure a seamless and impactful experience for all. Let us carry forward the learnings from today's session into our respective practices and continue contributing meaningfully to the profession. So thank you and have a wonderful day ahead.
Thank you, Ajinkya.
Thank you, ma'am.
Thank you, Arunji, and thank you, Aarti. And thanks to our chairman, Chitray sir also.
Arun, can we end the session over here?
Yes, sir.
Yes. Ma'am, then yes, you can leave. Support. Thank you, ma'am.
Thank you all.
Hello? Yeah, just end it. It's done.